LiveStream.trade. WeCopyTrade. WeCopyTrade.
welcome back with WeMasterTrade Farm. It's me, Scarlett here, and I'm beyond excited to be here with you today for another incredible live session. Whether you've been with us for a while or this is your first time joining, buckle up because we've got a jam-packed session full of insights, strategies, and the kind of tips that will take your trading game to a whole new level. Who's ready to crush it today? So let's get some love in the chat. Grab your favorite emoji, hit that like button, and let me see where you turn it from. Whether it's New York, London, Tokyo, or anywhere in between, we want to hear from you. The WeMasterTrade community is global, and today we're all in this together. And hey, if you're not subscribed yet, you know what to do. Smash that subscribe button and stay in the loop for all the tips and tricks that will help you level up. Alright, I'm loving the energy right now. So we got traders tuning in from all over the world, and it's awesome to see everyone coming together to share, learn, and grow. Let's keep that momentum going because today's session is going to be next level. We got some special guests who are here to share their stories and strategies that have helped them rise to the top of their game. Trust me, you don't want to miss a single word. First up, I have the honor of introducing Helen, an absolute beast in the forex market. Helen has been mastering forex trading for over 2 years and a half, and she is here to share some seriously valuable insights with all of you. So Helen, how's it going today?
Hey Scarlett, I'm feeling fantastic and thrilled to be here. It's always wonderful to engage with the WeMasterTrade community and discuss the successful approach I recently adopted. I'm eager to delve into some of the strategies I've been applying in the forex market.
I love that energy, Helen. I know our audience is pumped to hear all about your forex journey. But before we get into that, let's not forget about our next guest. Raph has been dominating the fund trading scenes, especially in the high-stake world of crypto and stock. So Raph, how's it going?
Hey Scarlett, I'm equally excited to be here. These sections will offer fresh topics for discussion, and today I'm thrilled to share some of the strategies that have been effective for me in fund trading. It's going to be an engaging section.
That's what we love to hear. So everyone watching, make sure you got your notepad ready because Helen and Ralph are ready to drop some serious knowledge bombs. We'll be diving deep into their experiences, challenges, and the strategies that have helped them thrive in the fast-paced world of trading. Alright Helen, let's get things off with you. You've been trading forex over a year and a half now, and I know the forex market can be a bit of a roller coaster. Can you tell us how you got your start in forex trading and what led you choose WeMasterTrade as your platform?
Certainly, Scarlett. I began forex trading about 2 years ago. What captivated me initially was the market vibrancy and the proprietor activity. The forex market is exceptionally dynamic, and I work attracted to the concept that there is always potential for success regardless of the circumstance. When I first discovered the WeMasterTrade, it immediately resonated with me at the perfect match. The resources they provide, including the sophisticated technical analysis and access to the real-time data, truly interest me. However, it's where the community aspect that clinched it for me. WeMasterTrade plays a strong emphasis on the aiding trader success by offering essential tools and support to advance regardless of your start point.
That's fantastic, Helen. It sounds like WeMasterTrade has really helped you elaborate your game. Now, forex is known for its volatility, and sometimes that can make or break a trader. How do you handle the ups and downs of the market without letting the pressure get to you?
A great question. Volatility can be challenging, but it also where the real opportunities are. The key is having a solid risk management plan. I always say you have to respect the risk. It's important to stay disciplined, and WeMasterTrade risk management tools help me to do that. Their real-time alert and customizable risk parameters allow me to react quickly, but with the control. When the market moves fast, you have to stay calm, trust your strategy, and not let emotion take over. And for me, that's where WeMasterTrade feature really shine.
That sounds seriously valuable insights, Helen. Managing risk and staying cool under pressure is definitely key in forex trading. Now, Raf, let's switch gears to fund trading. You have been crushing it for nearly 2 years, specializing in long-term strategies. Can you tell us what drew you to fund trading and how it differs from other forms of trading?
Absolutely, Scarlett. Fund trading revolves around strategic long-term growth. It's not about seeing quick wins, but constructing a portfolio that can steadily advance over time. What truly distinguishes fund trading is the need to consider both short-term and long-term perspective. Careful risk management is crucial, while simultaneously keeping an eye out for emergency opportunities. WeMasterTrade real data and analysis tools have been instrumental in achieving this balance. They enable me to make well-informed decisions that align with my long-term strategies, even when the market presents unexpected challenges.
I love that. Fund trading definitely it requires a lot of patience and foresight. Raf, how do you stay focused on the bigger picture, especially when the market gets rocky?
Well, patience is paramount in fund trading. The market experiences fluctuations, but short-term ups and downs shouldn't dictate you long-term strategies. A crucial lesson I've learned is to maintain emotional detachment. Don't get overly excited when things are going well, and don't panic when the market dips. WeMasterTrade risk management tools assist me in staying disciplined even during volatility. I can set precise risk parameters and have peace of mind knowing that I'm not overexposed even when the market behaves unpredictably.
That's such solid advice. Keeping your emotions in check is definitely a big part of being successful in trading. You both have shared some serious gems so far, but let's talk about the tools that have helped you get to where you are today. Helen, can you share one specific feature on WeMasterTrade that's been a game changer for you in Forex?
Alright, a tool I absolutely rely on is the account insight feature. It's offer up-to-the-minute data on how my account is performing, and I use it to observe patterns, evaluate my trades, and make a better informed choice. Whether I am pinpointing the best time to enter the markets or deciphering market trends, this tool gives me an edge. It has enabled me to spot opportunities that I might not have noticed otherwise.
That sounds like a total game changer, right? Having a real-time insight is crucial, especially when you need to make quick decisions. Raf, how about you? What's been your go-to tool in fund trading?
Well, for me, it's all about the risk management tools. They allow me to customize the amount of risk I'm willing to take on any trade. This has been key for me, especially in volatile markets like crypto. WeMasterTrade helped me stay disciplined and in control, ensuring that I never take on more risk than I'm comfortable with. That's what keeps me grounded even when the market is going wild.
Risk management is so important, especially in today's fast-moving markets. Whether you're in Forex or fund trading, having the right tools makes the world of difference. I hope everyone's taking notes because Helen and Raf are dropping some serious pro-level insights today. Alright traders, I'll be kicking things up with a notch because it's time to dive into one of the most powerful features here at WeMasterTrade, the package comparison. Whether you're a fresh-paced newbie eager to get your feet wet or a seasoned pro looking to scale your game to a new heights, this segment is for you. This is where you'll find the perfect trading package to match your goals and take your trading from good to great. Now, let's be clear, at WeMasterTrade, we know there's no one-size-fits-all in trading. Every trader is unique, with different styles, risk tolerances, and strategies. That's why we offer multiple customizable packages to meet you exactly where you are in your trading journey. Whether you're aiming for high risk and high rewards or you prefer steady, methodical approach, there's something here for you. And to break it all down, we got the awesome Helen and Ralph, two of WeMasterTrade finest. They both worked closely to these packages and are here to give us the inside scoop on how to leverage each one to its full potential. So drop a hit if you're ready to find out which package will take your trading game to the next level. Alright, let's jump in. Helen, you've been with WeMasterTrade for a while now, and you're seeing firsthand how these packages can elevate traders' experience. Can you kick things off by walking us through how both new and experienced traders can benefit from the package comparison? Why it is such a game-changing feature in the WeMasterTrade experience?
Absolutely, Scarlett. I really enjoy discussing these packages because it's where the traders can truly customize their experience. The package comparison feature simplifies the process for the trader to understand precisely what they are getting. When you visit the website, there are detailed comparative overview of each package that includes information like the initial balance, profit targets, daily loss limits, and more. All the essential details are presented in a straightforward, easy to navigate table. It's not about structured as a trader in selecting the best tool for their success. Okay, let's talk about the standard package, one of the most popular options. This one is great for the trader who got some experience and are ready to level up. You start with an initial balance up to the 200,000, which give you plenty of room to trade confidently and make the strategic move. The profit target set at 6%, which is perfect for the trader aiming for steady, sustainable growth. And the daily loss cap is 4%, so you got enough rating room to ride out market swing without stretching too much. It's an awesome balance between opportunity and security.
Wow, that sounds like a perfect stepping stone for traders looking to level up without jumping too deep too quickly. A $200,000 balance and a solid 6% profit target give you a ton of flexibility to build momentum. But for those who are looking for something a bit more thrilling, let's talk about a 5-10-10 package. Helen, I hear this one's a favorite for high risk, high reward traders. What makes the 5-10-10 such a standout?
The 5-10-10 packets. Now we talk about big plays. Like the standard packet, you start with $200,000, but this packet is for the draw trader who are ready to take on the bigger risk for the bigger rewards. The daily loss cap is 5%, giving you more flexibility in how you handle the market. But here the kicker, the profit target jumps to the 10%. This is perfect for the trader who have the confidence in their strategies and are looking to draw major gains. It's all about having a higher tolerance for the risk in exchange for the bigger payout.
Yes, now that's what I'm talking about. A 5% loss cap and a 10% profit target. That's definitely for traders who aren't afraid to go big and swing for the fences. But what if someone looking for something more relaxed? Maybe they want something simpler without all the pressure of hitting specific profit targets. Raf, I've heard about the 5-10-0 package. Can you break it down for us?
Absolutely, Scarlett. The 5-10-0 package is ideal for traders who want a straightforward, no-nonsense approach. You start with a $100,000 balance, but here's the cool part: there's no profit targets. You can trade freely without the stress of hitting specific percentages. It's just you, the market, and your strategies. The daily loss cap stays at 5%, giving you some structures, but the beauty here is that it allows traders to focus on consistency without worrying about specific goals.
Wow, that sounds like a dream for traders who just want to trade without all the restrictions. Total freedom, no pressure, just you and the market. Now, Raf, what about those traders who want a bit more control over their risk management but still want to play in that high-stake arena? What can you tell us about the 5-10-10 no PC package?
Well, the 5-10-10 no BC package is perfect for traders who want more control over their trades. You will still get the $200,000 starting balance and the 5% daily loss cap. But the flexibility is the real selling point here. This package allows you to tweak and adjust your trading parameters to match your style and risk management preferences. Whether you're reacting to market changes or want to experiment with different strategies, this package gives you the freedom to adapt without losing the safety net of risk management.
Flexibility and control in volatile markets, that's huge. I love how these packages are giving traders more ways to adapt and grow. Now we'll cover a lot, but I've been hearing whisper about something really special, the custom package. Helen, tell us what made this so exciting.
Okay, the custom package is where the thing get really exciting. This is for the trader who want it on full control, full customization, and a massive stress balance. You get a choice for bring 1 million initial balance. Yes, it's 1 million, but that's just the beginning. The real beauty is that you can customize everything. The daily loss limit, overall loss limit, and even your profit target. It's perfect for the trader who know exactly what they want doing and want to grab a trading experience that matches their exact need. It's intimate in freedom and control.
1 million starting balance and the ability to customize your entire trading experience, that's next level trading. Whether you're a risk taker or a methodical trader, the custom package sounds like the ultimate playground for those who want to take their trading to the stratosphere. Well, alright traders, let's quickly recap. Whether you're just starting with the standard package, going for bigger reward with the 5-10-10 package, enjoying full freedom with 5-10-0, taking control with 5-10-10 no PC, or customizing everything with the custom package, WeMasterTrade has the perfect option for you. The only question is which one is calling your name. So head over to the package comparison section on our website right now and check it out for yourself. We got packages designed to fit every trader no matter where you are in your journey. Let us know in the chat which package speaks to you, and our team is ready to help you get started. The future of trading is in your hand, and let's make it happen. So alright traders, this is where the magic happens. We talk about the packages and how you can start with your trading journey at WeMasterTrade. So let's be real, success in trading isn't just about the package you choose. It's also about understanding and sticking to the rules. The conditions we set at WeMasterTrade are designed to not only keep you safe, but also have you grow and take your strategies to the next level. Now, whether you're just getting started or you have been trading for years, these conditions will act as your roadmap. So let's dive into the rules and define our trading environment, because if you understand the rules, you can master the game. First up the list, and arguably one of the most important, the daily loss limit. Raf, you've been through it all, the highs, the lows. Can you kick things off by explaining to everyone how this daily loss limit works and why it's so crucial for managing risk?
Absolutely, Scarlett. The daily loss limit is one of the most essential protections any trader can employ. It serves as a daily circuit breaker to prevent you from suffering significant losses on a challenging day. The concept is straightforward. There is a limit to how much you can lose in a single day of trading, and it's determined by the greater of true values, your account balance or your equity at the beginning of the day. So let me break that down with an example so everyone understands it clearly. Example 1. Let's say you got a balance of $105,000, but due to some open trades, your equity, which include floating profit and loss, is $107,000 at the start of the day. If you're working with a 4% daily loss limit, that means you can lose up to $4,000. And if your equity falls below 103,000, you are done trading for the day. And for the second example, on the flip side, if your balance is $100,000 and your equity is 99,000, the same 4% loss limit would mean your account would be liquidated if your equity dips below $96,000. So the point is, the daily loss limit is there to make sure a bad day doesn't weigh you out completely. It's about protecting your account and giving you the chance to regroup and come back stronger the next day.
Got it. So it's like an insurance policy for your trading day. You hit that limit and boom, you're out before things get out of hand. But what happens if a trader accidentally crosses that line? Can they keep trading?
A great question, Scarlett. No, if you break the daily loss limit, your account will automatically liquidate. On your open position will be closed and you won't able to trade again until the next day, or unless you buy a new trading package. Here's the thing, the liquidation is automatic and immediate. It's designed that way to prevent further losses. But here's the word of caution. Market fluctuation can sometimes cause you to lose a bit more than the limit, depending on how far the market is moving.
Oh, it's a hard stop. Definitely something traders should keep an eye on to avoid. Now that we understand what the daily loss limit is and what happens when it's hit, the next question is how to avoid hitting that limit in the first place. Raf, you've been in the trading trenches for years. Can you share some practical strategies that traders can use to stay within their daily loss limit? We're all ears.
Well, you got it, Scarlett. Staying within the daily loss limit is all about being disciplined and following a solid risk management plan. So here are a few key strategies that have worked wonder for me and countless other traders. First, and I can't stress this enough, always use a stop loss. I know it sounds simple, but it's absolutely critical. The stop loss ensures that if the market moves against you, you are out of the trade before things get out of hand. Think of it as your safety net.
That's like setting up a guardrails on a mountain road, right? It's there to stop you before you go off the cliff.
Exactly, Scarlett. It's that extra layer of protections. Now the second strategy is position sizing. This is where a lot of traders slip up. You should never risk too much on a single trade. A good rule of thumb is to risk no more than 1 to 2% of your account balance per trade. This way, even if the trade doesn't go your way, you are still far from hitting your daily loss limit, and you can keep trading without any major setbacks.
So it's like building your defense. You don't put everything on one play, right? You spread out the risk. Makes sense. But what about those moments when traders feel tempted to trade after their losses? You're not trying to get it all back in one trade.
Oh, that's a big one, Scarlett. Chasing losses is one of the biggest mistakes traders can make, especially newer ones. This brings me to my third strategy, don't chase losses. If you're having a tough day, take a step back. The market will always be there tomorrow, and if you start chasing losses, trying to recover too quickly, it's easy to make emotional decisions that lead to even bigger losses. And before you know it, you'll hit that daily loss limit and you are out for the day.
So true, it's like trying to sprint when you already winded. You're more likely to make a mistake. Now, Raf, these strategies sound spot on, but how do traders stay mentally strong when things aren't going their way? What keeps them from falling into the emotional trap of chasing losses?
Well, it's all about mindset, Scarlett. Trading is just as much as a mental game as it's a number game. You've got to stay calm and focused. One trick is to always have a trading plan before you even place a trade. That way, when things get tough, you stick to the plan and avoid making impulsive moves. And if you find yourself getting emotional, just stop. Take a break, step away from the screen and reset your mindset.
Thank you, Raf, for those incredible tips on managing daily loss. Now, let's shift our focus to another critical element of risk management, the maximum loss limit. This limit is like your long-term safety net, ensuring that you don't deplete your account over time. Unlike the daily loss limit, which resets at the end of each day, the maximum loss limit is cumulative. When you reach it, your account will be locked and your trades will be closed. To dive deeper into this, let's discuss how the maximum loss limit works and how it's calculated, and why it's essential for traders at every level. Whether you're a new trader looking to maximize risk or an experienced trader scaling your strategy, these limits ensure that you don't go beyond a point of no return. Into the mechanic of the maximum loss limit, could you walk us through how this rule works and what trader needs to keep in mind that they plan their trading strategies?
Of course, Scarlett, the maximum loss limit is a vital rule that's often overlooked but extremely important. Essentially, it's there to prevent traders from experiencing catastrophic losses by capping how much you can lose across the line of your trading account. Let's break it down. The maximum loss limit ensures your account equity never falls below 94% of its initial balance. So, if you start with a balance of $50,000, your account will be closed once your equity falls to $47,000. That's a total allowable loss of $3,000. However, it's not all bad news. If you start making profit, the limit adapts, giving you more breathing room as your equity grows. For example, if your account balance increases to $52,000 and you now made $2,000 in profit, your new maximum loss limit would then allow you to lose up to $5,000 as you are essentially locking those gains. The maximum loss limit acts as a long-term safeguard. It's designed not only to protect your account, but also to encourage disciplined trading by setting boundaries. The goal is to ensure you don't dig yourself into a hole that's too deep to recover from. I got a few specific examples for you. The first case, let's say your account balance starts at $50,000, but your equity dropped to $49,000 due to some market losses. You are allowed to lose another $2,000 before your account hits the critical $47,000 threshold and is automatically closed. And for the second case, now if you're doing well and your equity rises to $51,000, you got some extra cushions, and at this point you are allowed to lose up to $4,000 before your account hits the same $47,000 limit. Well, to figure out where you stand, the maximum loss limit is calculated by adding the sum of your closed positions and factoring in any open positions that are still running. Your trading dashboard will show two key metrics. First of all, the max permitted loss, which is how much you are allowed to lose overall, and the remaining loss, which is the loss left before your account is closed. So now, what happens if you hit the limit? Well, unfortunately, if your equity hits the maximum loss limit, the system will automatically close your account for the day, and all your open position will be liquidated, whether they are profitable or not, and you will be unable to trade for the rest of the day. And to resume trading, you will need to purchase a new trading bucket.
Thanks, Red. That definitely helps clarify the nuts and bolts of the maximum loss limit. It's kind of like a safety buffer, isn't it? It's there to keep you from spiraling out of control, especially when markets get volatile. Now, I imagine this rule impacts different traders in different ways, whether you're a cautious trader who keep their risk low or a more aggressive trader trying to maximize profit. This limit is one of those things you can't afford to ignore. So we will continue with the next session after a short break.
copy trade. copy trade. We copy trade.
Hello, welcome back. So in the next session, let's bring Helen, our risk management expert. Helen, what do you think are the most common mistakes traders make when it comes to managing their maximum loss limit? And more importantly, what strategies can traders implement to ensure that they never get close to it?
Great question, Scarlett. You are absolutely right. No matter what type of trader you are, ignoring the maximum loss limits can be costly. In fact, it's one of those things that sneak up on traders who aren't paying attention to the long-term picture. And I say the most common mistake is underestimating how quickly cumulative losses can add up over multiple trades. Here are some key strategies I recommend to stay well within your maximum loss. For the first one, set stop loss order on every trade. This is your first line of defense. Setting a stop loss means you are deciding in advance how much you're willing to lose on a particular trade. The system will automatically flow your trade. If hit that number, we protect you from letting a losing trade without a plan. For example, if you're only willing to lose $500 on a particular trade, you set that at your stop loss and you won't have to worry about spiraling.
I love that. It's like putting a safety belt on each trade. Once you're locked in, that stop loss is out of your hands.
Exactly, guys. It's all about discipline. Now, the next one is manage your position sizing. This is a big one. Often traders, especially newer ones, get carried away by putting too much capital into a single trade. But when you risk too much, you also risk losing a larger percentage of your account if the trade goes south. A good rule of thumb is to risk no more than 1 to 2% of your total account balance on any single trade. For example, if your account balance is $50,000, you should only risk about $500 or $1,000 per trade. This keeps your potential losses manageable and well within your limits.
That makes total sense. You're not putting all eggs in your one basket, and it gives you more room to breathe, right?
Exactly. It's all about spreading the risk so you don't take too big a hit on any one trade. Monitor your account equity regularly. This may sound basic, but it's incredibly important to keep an eye on your account equity throughout the day. It's easy to get caught up in the market's high and low, but you should always be aware of how close you are to your maximum loss limit. Your dashboard make it easy to check your remaining loss. So use it. If you see that you're getting close to the limit, it's time to take a step back and re-evaluate your strategy.
It's almost like watching your fuel gauge. You don't want to be driving on fumes without knowing it.
Exactly, and no one wants to get stuck on the side of the road. And the next tip is to create and stick to a trading plan. Having a well thought out trading plan is one of the most powerful tools in the trader's arsenal. This plan should outline not only your profit goals, but also your risk management rules. For example, if you have a few losing trades in a row, does your plan tell you to take a break, risk assets, or change your strategies? The ideal is to have a preset series of rules so you don't make impulsive decisions in the heat of the moment.
It's like having a roadmap, right? You know where you're going and you have a contingency plans for when things don't go as expected.
Exactly. The market can be unpredictable, but a solid plan keeps you grounded. The next one is to regularly review and adjust your strategies. Even the past laid plans need to be reviewed and tweaked from time to time. If you find that you are approaching your maximum loss limit too often, it may be a sign that your risk management strategy needs adjusting. Maybe you need to tighten your stop losses or reduce your trade sizes. The key is to stay flexible and adapt to changing market conditions, while always keeping your risk in check.
That's great advice, Raf. It's all about constant improvement. You can't just set it and forget it. You got to be ready to adjust based on your results and the market.
Absolutely, trading is dynamic and your strategies should be too.
Thank you for the fantastic breakdown of the maximum loss limit, Helen and Raf. This leads us perfectly into our next key topic, the profit consistency rule. This rule is critical for ensuring long-term sustainable success in trading and as it helps measure and maintain consistency in your profit. Now, to give us a clearer picture of how the profit consistency rule works and why it's important, let's turn to Helen. Helen, can you break it down the rules for us, and how is it calculated, and why is it important for traders to focus on their consistency rather than just aiming for big wins?
Of course, Scarlett, the profit consistency rule is a powerful metric that helps you understand how stable your profits are over time. It's not just about making a big gain on one or two good days. It's about being consistent day in and day out. So here's how the profit consistency rule is calculated. You take your highest single day profit and divide it by the total of all your profit and losses over a given period, usually a month or a quarter. You then express that result as a percentage. Let's go through an example. Say your bad day brought in the $200 in profit, but over the month your total profit and losses add up to $410. In that case, your profit consistency ratio could be about 48.7%. This ratio shows how much of your performance comes from one standout day. Ideally, you want this percentage to be lower, under the 20%, because that means your profits are more evenly spread out across all your trading days. Now, why it is important? Allow profit consistency ratio indicates that you're not just relying on a couple of big wins to stay profitable. Instead, you're showing that your strategy works consistently over time, even on those days when the market even gives you big win. That kind of consistency is the hallmark of successful long-term trader.
That's a great explanation, Helen. So just to clarify, a lower ratio means you're more likely to make steady gains rather than being overly dependent on a few good days, right?
Exactly, Scarlett. When you too rely on just a few big wins, it often means that your strategy is risky or inconsistent. You could go to a long stretch where you're making much money or even losing it. But if your profit consistency ratio is low, it shows that your performance is moderate and that you're trading more predictable and stay over time.
That's incredibly insightful, and it seems like a critical metric for any trader who's serious about long-term success, right?
Exactly. Consistency is the key to sustainable profitability. Big swings are great, but if they follow by the big losses or long periods of break-even trading, it's hard to maintain momentum. With the profit consistency rule, trader can keep an eye on how reliable their strategy is over time.
Awesome. Now that we got a solid understanding of what the profit consistency rule is, let's dig into some practical strategies to help traders maintain a low ratio, ideally under 20%. Raf, I know you got some great tips for us. Can you walk us through some techniques that traders can use to stay consistent and ensure their ratios stay in check?
Absolutely, Scarlett. The profit consistency ratio is a powerful indicator, but it takes careful management to keep it low. So let's talk about some practical ways traders can improve their consistency and avoid becoming too dependent on those rare big wins. One of the most effective strategies to keep your profit consistency ratio low is to diversify your trades. This means spreading your investment across different markets, asset classes, or even trading strategy. If you only trade one market, let's say forex or stock, you risk being too reliant on that market performance. By diversifying, you reduce the impact of any single loss and create more stability in your overall performance.
That makes a lot of sense. So if you're only trading in, let's say, the US stock market, a bad week could really hit my profit consistency hard. But by adding trades in, for example, commodities or forex, I could balance out some of that risk, right?
Exactly, Scarlett. It's all about balance. When one market isn't performing well, another market might be doing better. This way, your overall performance stays smoother and you are not relying on just one or two trades to pull you through. Next up is position sizing. One of the biggest mistakes traders can make is over leveraging, taking on positions that are too large relative to their account balance. For example, if you have a $10,000 account, putting $5,000 into a single trade is risky because if that trade goes south, you could lose a significant portion of your capital. Instead, aim to keep your position sizes small and manageable, say no more than 1 to 2% of your account balance per trade. This reduces your risk and helps ensure that losses doesn't overwhelm your profits.
Right, so it's not just about making the right trades, but also making sure you're not putting too much of your capital at risk on any single trade. Smaller, more controlled trades lead to steadier results over time, right?
Exactly. By managing position sizing, you prevent any single trade from having too much impact on your overall performance. It's all about control and discipline. Another crucial element is having a well-defined trading plan. Without a plan, it's easy to get caught up in the emotion of trading, whether that's the excitement of a potential win or the panic of a sudden loss. A solid plan outlines exactly when you will enter a trade, when you will exit, and how much risk you are willing to take. Having this rule in place keeps you grounded and helps ensure that your trading decisions are consistent, which in turn helps keep your profit consistency ratio in check.
That's a really good point. A lot of traders, especially newer ones, probably jump into trades without a solid plan and end up making emotional decisions, right?
Absolutely, Scarlett. It's so easy to get emotion in the heat of the moment, but if you have a plan, it's much easier to stay disciplined and avoid impulsive trades that could hurt your performance. This brings us to stop loss orders. A stop loss is an automatic exit. Thus, you set up to close a trade if it moves against you. This helps to cap your losses on any single trade and protect your account balance. By using stop loss order, you can avoid these catastrophic losses that can you throw up your profit consistency.
I like the idea of using stop loss orders. It's like a way to take the emotion out of the decision-making process.
Exactly. It's like setting up a safety net. Once your stop loss is in place, you don't have to worry about watching the trade 24/7. If things go south, the stop loss takes you out of the trade automatically, helping you stick to your plan and avoid large unexpected losses.
So it's
Another important strategy is to regularly review your performance. Just because you set up a solid plan and strategies doesn't mean you should put everything on autopilot. It's crucial to check your trades, see what's working, and make adjustments as needed. You might find that certain markets or strategies are delivering more consistent results than others, and by keeping a close eye on your performance, you can tweak your approach and improve your consistency over time.
So it's like performing maintenance of your trading strategy, always looking for ways to optimize and improve.
Exactly. Just like a car needs regularly turn up, your trading plan does too. Continuous improvement is key to keeping your profits steady. Finally, and this is the big one, avoid emotional trading. Whether it's fear after a loss or overconfidence after a win, emotions can lead to poor decision making. If you stick to your strategies and avoid chasing losses or getting overly excited after a good day, you'll see much more consistent results.
That's such an important point. Staying calm and disciplined even when the market is going crazy is easier said than done, though, right?
Well, it's definitely tech practice, but staying level-headed is crucial for long-term success. If you can control your emotions and stick to your plan, you will be far more likely to maintain consistent profits.
Alright traders, let's dive into a crucial aspect of effective trading, the risk consistency rule. This rule is key to maintaining both stability and long-term profitability in your trading account. Raf, I know you got a great way of explaining it. Can you walk us through what the risk consistency rule is and why it's so important for traders to follow?
Shooting Scarlett, the risk consistency rule is all about ensuring that you manage your risk in a disciplined, consistent manner. It limits the risk per trade to no more than 2% of your initial account balance. This is really important because it prevents large swings in your equity and helps mitigate the risk of significant losses due to sudden market movement or unexpected events. So let's break it down a little more. First of all, the maximum risk per trade idea. You shouldn't risk more than 2% of your initial balance on any single trade idea. This includes any floating losses, or you need to factor in on potential exposures. The next one is to trade idea definitions. Multiple trades on the same assets in the same direction are considered single trade ideas. On the other hand, trades on different assets or in opposite directions are treated as separate ideas. For example, if you open several positions on gold and buy, they would count as one trade idea, and the combined risk must remain under 2%. But if you have a gold buy and a GBY sell, they are treated as two separate ideas, each with their own 2% risk limit. Following this rule smooth out your equity curve encourages disciplined trading and, most importantly, reduces the chances of massive losses.
Thanks, Rav, and that's really helpful overview. Now let me throw this back to our audience for a second. Traders, have any of you ever found it tricky to stick to the risk consistency rule? How does it feel to have the risk limit in place? Does it ever get in way of your trading strategy?
Absolutely, Scarlett. The main point to remember about the risk consistency rule are for the first point, risk per trade idea. Stick to the risking no more than 2% of your initial account balance on any single trade. This keeps potential losses manageable and ensure you don't risk too much on any trade. For the second point, single trade idea. If you're opening multiple trades on the same asset and in the same direction, they count as one trade idea. So your combined risk must stay within that 2%. And then next one, separate trade ideas. Trade on a different asset or in different direction are considered separate ideas. XFG can have its out 2% risk, but it's mindful to keep track of them. And why does this matter? It stabilizes your equity curve by preventing huge swings in your account balance. It promotes discipline by encouraging traders to think more carefully about their risk, and most importantly, it reduces the risk of major losses that can really hurt your overall performance. So in short, adhering to this rule helps keep your trading account safer and support long-term success.
Great, Helen. Now I know some of you might be wondering how to make sure you actually stick to this rule. Let's shift gears to get into some practical strategies for making it easier to follow. Raf, could you share a few tips on how traders can stay disciplined and avoid breaking the risk consistency rule?
Of course, Scarlett, sticking to the risk consistency rule takes some planning and discipline, but it's totally doable with the right strategies in place. So here are a few key tips. First and foremost, clearly set your maximum risk per trade and to stay within the 2% limit. You can use risk management tools or calculator to help with this. Most platforms have built-in tools that allow you to automate risk limits.
That's a good point. Having that automation take a lot of pressures off, right? No need to constantly double check. Your platform does the heavy lifting.
Exactly, it makes it so much easier to stick to your risk limits when the platform is handling the number of you. It's also important to keep track of the total risk across multiple trades on the same assets. For instance, if you open several positions on gold buy, make sure the combined risk for on those trades doesn't exceed 2%. This is where traders sometimes slip up. They open multiple positions without realizing that combined they are risking more than they intended.
So even though the trades are technically separate, if they aren't the same assets, you got to look at them as one entity, right?
Exactly, Scarlett. Treat them as one idea because they are all exposed to the same market movement. Speaking of different trades, it's equally important to treat trades on different assets or in opposite directions as separate trades. Ideas. This way you can manage each trade's risk individually without exceeding the 2% rules on any single trade.
Right, so you could be running a gold buy and a GPY sell at the same time without violating the rule, as long as you manage the risk for each one separately.
Exactly, just make sure you are keeping an eye on the risk for each idea individually. Use risk management tool. I would also recommend using risk management features that many trading platforms offers, like the automatic position sizing or stop loss order. This tool can help control your exposures and prevent you from overextending your risk.
And I imagine these tools really help prevent the moments where you're tempted to take on too much risk in the heat of the moment, right?
Absolutely, it takes the emotions out of the equations and helps you stay disciplined. Lastly, make it a habit to regularly review your trading activity. This is sometimes a lot of traders neglect. Reviewing your trades helps ensure that your risk per trade remains within a set limit. And if you notice any patterns or areas where you are taking on too much risk, you can adjust your strategy to stay compliant.
It sounds like regular checks-in are crucial to spotting potential issues before they become big problems.
Exactly, Scarlett. It's all about staying proactive.
Great tips. Right now, I'd like to move on to an important update regarding how we handle risk consistency violations. If an account is terminated due to breaking this rule for the first time, except for those on a no PC package, there are now two options available for customers. First, they can choose to reset their account to its initial balance, which gives them a fresh start. Alternatively, they can choose to reactivate their current account, keeping the existing balance and setting intact. Alright, I think that covers. Let's make sure we applying these risk management strategies and take advantage of the new options available for account management. Thanks Helen and Raf for those insights. Next up, we will move on to the promotions. Our vision is to foster a thriving community of elite professional traders and positioning WeMasterTrade.com as the go-to platform for anyone serious about advancing their trading career. Whether you're just starting or have years of experience under your belt, we're committed to providing opportunities and resources that help you succeed at every stage of your trading journey. At WeMasterTrade, we understand that each trader's needs are different, and we're here to support you with tools, insights, and personalized packages that cater to your specific trading goals. And if you are ready to take your trading to the next level, you'll definitely want to stick around to hear about the exciting offer we got lined up. The new promotion plan will be unveiling today is specifically designed to help traders get more out of their experience with WeMasterTrade and WeMasterTrade.com. We focused on creating more opportunities for growth, increase profitability, and long-term success, no matter where you are on your trading journey. So Helen, can you help me with the AP0 package?
Okay, with that said, let's jump into our first promotion, which exclusively available to our WeMasterTrade affiliate partner, the AP0 package. The package is designed to help you unlock even greater potential with WeMasterTrade, offering unique benefits and features that can really boost your performance. The AP0 package presents an incredible opportunity targeted specifically for our WeMasterTrade affiliate partners. Here are the key details. The package name is the AP0. Code charge $3 fall under the 5100 category and come with an account balance of the $30,000. To qualify for this packet, customers need to complete the KYC process and sign up for our AP program, which have created a skill and a compliant trading experience for all participants. When it comes to payment term, profit sharing allows you to earn up to 50% of your profit. For instance, if you generate a 10% profit amount to the 3,000, your potential share could be up to the $1,500. You can acquire as many packages as you wish. However, only one can be active at a time. After closing an account, you are eligible for a new package. There are no limits on the number of payments you can receive, but keep in mind that account hitting the payment threshold cannot withdraw funds until certain customer referral conditions are satisfied. This package is a fantastic way to kickstart your trading journey with a significant balance while minimizing your initial investment, making it perfect for those wanting to explore our platform with reduced financial risk.
Thank you, Helen. Now moving on to our one of the most popular promotions, the BOGO buy one get one free offer. This is an incredible opportunity for traders who want to maximize their trading power without additional cost. Ralph will show us how it works.
So when you purchase a 50,000 trading account, you will receive an additional 25,000 account, and it's absolutely free. This gives you the opportunity to enhance your trading experience with even more capital at your disposal. Instant funding. There is no waiting period. Your accounts will be funded instantly, allowing you to start trading right away. And also, you can enjoy a daily drawdown limit of 2% and a maximum drawdown limit of 4%. Additionally, the profit target is set at 6%, which provides balanced risk management and profit opportunity. This offer is available to all traders regardless of their experience level. However, keep in mind that this is a limited time offer, so don't miss your chance to take advantage of it. And to claim any of these fantastic offers, follow this step. First of all, log into your account and purchase any package with a payment fee of at least $175. Sign the online contract for the account you purchased. Then contact our customer service team for assistance in verifying your payment and creating your account. Once everything is processed, your free bonus account will appear in the personalized section of your dashboard within 24 hours. All you need to do is to log in and activate your account, and you'll be all set to start trading.
Thank you, Ralph, and we hope you're as excited about this promotion as we are. And before we finish this live session, we will move to the news calendar for today.
So for the first events, the Switzerland gross domestic product, which GDP growth rate measures the change in the value of all goods and services produced in your country, are lower than expected. 0.2% growth suggests a slowdown compared to the 0.4% previous rate. And for the potential impacts, for financial markets, a weaker GDP growth rate could weigh on the Swiss francs and Swiss equities, particularly sectors tied to domestic demand. For foreign traders, CHF could weaken against major currencies like Euro and USD if markets see this as a sign of economic stagnation. And for economists, the slower growth rate could signal economic headwinds, leading to potential monetary easing by the Swiss National Bank. The next event is the Euro Spanish Flash. The Consumer Price Index, which is CPI, measures inflation in Spain, which is one of the largest economies in the Eurozone. A higher than expected 3.0% inflation rate suggests increasing price pressures.
Well, that brings us to the end of today's session, and thank you all for joining us and taking the time to know more about the starting features and opportunities at WeMasterTrade. It's been a pleasure sharing these insights with you, and if you have any further questions, feel free to reach out to us through our support channels or connect us on our social media. And hey, the market never sleeps, so get out of there, stay focused and trade smart. Thanks again to being the part of this amazing journey with us. And until next time, stay safe and stay profitable, and happy trading.